All right, what is up, traders? What's up, tycoons? Super excited for today's video. We're going to be doing the latest installment to the free trading course playlist that I put together on YouTube for completely free. Make sure to check that playlist out after you finish this video. What we're going to do is go over my favorite chart patterns, some of the most common chart patterns, learn how to identify them, tell whether they're continuation patterns, maybe reversal patterns. And by the end of this video, you should have a pretty good understanding of some of the basic chart patterns that can appear on the trading battlefield, right? I like to say trading is like going to battle. It's like going to war. You need to have the proper weapons at your disposal and know how to use those weapons so that way you can increase your odds of success on the battlefield. Today's video is going to be another weapon you can add to your arsenal. And the trading course is really designed to go from A to Z to start you off with the things you want to begin learning and some of the very beginning things that you want to learn. And as it develops, you'll see how you can take some of the strategies from the previous videos, combine themselves together. So that way you can have 2, 3, 4, 5 different indicators really helping you to give confidence and give you that edge that you need. So make sure to smash the like button, subscribe to the channel if you guys are new, and we'll go ahead and jump straight into it. Starting off with our first pattern here, the symmetrical triangle. So some of the attributes, all right, this is either a continuation pattern or a reversal. All right, and the reason being is because it's symmetrical. So you could get a breakout to the upside and you could get a breakout to the downside. And that's what we go over here. Indication is bullish or bearish, just depending on the breakout. Now, for the breakout confirmation, the confirmation for this pattern is a close above or below the converging trend lines on above average trading volume. Volume is very important, and I recently covered that in a separate video in the trading course playlist. Now, measuring, what you want to do is subtract the height of the lowest low and the highest high of the pattern, and then add or subtract this amount to the breakout level, depending on which way the breakout moves. Meaning, what you would do is you would basically measure this line right here, okay? And you would come in, take the highs to the lows, right? And measure this. And now you would have this line and you would put it on the top for a breakout or on the bottom for a breakdown. Okay, just depending on which way the breakout moves. Now, the volume declines through the symmetrical triangle formation and then expands on the breakout. So as you see the pattern developing and forming, volume should be dying down, and then you want to see volume expand and increase on the breakout or the breakdown. Now, the next pattern is going to be an ascending triangle. This one is going to be a continuation pattern. All right, and this is a bullish continuation pattern. Now, the breakout confirmation for this pattern is a close above the highs on average trading volume. The way to measure this is you want to subtract the height from the lowest low of the pattern and then add it to the breakout level. Okay, so if we visualize that real quick, take the lowest low here, we add this to our breakout level, and then that is going to be our target for the measured move. Now, when it comes to volume, the volume declines through the ascending triangle formation and then expands when the breakout occurs. The next pattern we're going to look at here is going to be the descending triangle, okay? And this is basically the opposite of the ascending triangle. It's a continuation pattern as well. Now, when I say continuation, this is what we mean, okay? You see how we're in a downtrend right here, and then the pattern forms. If the pattern is going to play out correctly, it's going to continue that previous trend. So if you were in an uptrend and then you started to see an ascending a descending triangle, that may not necessarily be a descending triangle and could be a false pattern, as you're looking for this to be a continuation pattern, specifically a bearish continuation pattern. Now, the confirmation for this pattern is a close below the lows on above average trading volume. And to measure this, you're going to subtract the height from the highest highs and the low of the pattern, and then subtract that from the breakout level. So same thing, you would take this line, and then that would be your measured move for the breakout once the breakout occurs. Very similar to the last one, volume is going to decline throughout the descending triangle formation, expanding on the breakout. The next pattern we're going to take a look at is going to be a falling wedge. Now, the falling wedge is another very common pattern that a lot of traders identify. This is a reversal and continuation pattern, all right? Meaning that you should be continuing the trend that you were in already. Okay, so we were in an uptrend, and then we started going down and zigzagging in the price action. That's where the reversal comes in. So we moved up, and then it's a longer term continuation pattern for, a higher move, but it's a shorter term reversal that you're looking for to come up near the previous highs. Now, the confirmation for this pattern is going to be a close above the upper trend line drawn across the highs with above average volume. Now, remember, volume is very important to a lot of these patterns. Okay, so now for measuring, the projected target price for the falling wedge pattern is the highest high at the beginning of the formation. So in a perfect world scenario, and you get a breakout on a falling wedge, you should come up to the highest high of the pattern formation. Now, volume tends to decline during the formation and then increase on the breakout. Now, this also works for the rising wedge, which is going to be the opposite basically of this, where you would have a move down and then you get this consolidation period, and then you break through that rising wedge and you get your move down. Okay, so the falling wedge is the bullish version and a rising wedge is going to be the bearish version. Now, the next one we're going to look at here is going to be a price channel. Now, price channels are really efficient and really helpful for just spotting some of the trends, right? This is either a continuation or a reversal pattern, and it can be bullish or bearish depending on if it's a reversal or, the direction of the channel. In this case, we have a downward price channel. All right. The confirmation for this pattern is when the stock or index closes above the upper trend line across the highs or breaks below the lower trend line with above average volume. So, a lot of people, will try to take the trades in these channels, okay? But you can also look for the breakout with increased volume, whether it's a breakout to the upside or a breakout to the downside. You want to see volume increase. Now, to measure, you're going to take the distance between the previous steep move leading into the final push before the breakout, and then add that amount to the breakout. As I mentioned before, the volume declines and increases during the formation, but it will expand on the breakout. Our next pattern is going to be the cup and handle. So, you have your cup right here, and then you get this little pullback consolidation period. That's going to be your handle. And then you're going to look for a breakout. Okay. Now, this is a continuation pattern. It's a bullish continuation pattern. You could have a bearish version of this, and that would be an inverse cup and handle. But this is the bullish continuation version. Confirmation is going to be when there is above average volume and the stock closes above the upper trend line drawn from the top of the handle. So, once you make your cup, that's going to be the top of your handle right here. And then you're going to have a trend line here at the top of your handle and look for a breakout of that top trend line that you have on your handle. Okay, now when it comes to measuring, the price target is obtained by measuring the distance from the right lip to the bottom of the cup and then adding that to the price level of the right lip. So basically you would do something like this, okay, and you have your cup and you would add that to the breakout, and that's going to be your projected move. Now, increased volume is typical following the shape of the cup, with higher volume as the left lip forms, decreasing volume as the bottom of the cup forms, and raising volume towards the right lip, which continues on to the breakout. So what that means is you get high volume here, you get low volume here, then you see an increase in volume, all right, as the handle forms, and then you start to see volume expand some more and continue on the breakout. Now over here we have the double bottom pattern / W pattern. Some people call it a double bottom, some people call it a W, but this is a reversal pattern. This is a bullish reversal pattern, and the confirmation for this pattern is a close above the upper trend line drawn horizontally across the intervening high between the lows with above average volume. Now, to measure this, you're going to take the distance between the two lows and a high and add it to the breakout level. The volume tends to decline during the formation and increase on the breakout. So as you can see here, right, we have our resistance, our breakout level. We have one bottom, we have two bottoms. This is our support right here. And then you get your breakout range from this period right here, from your support up to your resistance. Okay. The next pattern we're going to look at is going to be double top / M, very similar to the double bottom. This is a bearish reversal pattern. The confirmation for this pattern is when there is a close below the lower trend line drawn horizontally across the intervening low between the highs with above average volume. Now, to measure this, you're going to take the distance between the two highs and the low and then subtract that from the breakout volume. And volume, you're going to see the volume decline during the formation, during this period here, and then expand on the breakout. So this is when you would look for the expansion. The next pattern that we have on here is going to be the flag pattern. This is a bull flag. Same thing as some of the others. You could have the bearish version of this, which would be a bear flag, and it would work just the same, but for bearish standards. Now, in particular, again, we're looking at a bullish flag pattern. This is going to be a continuation pattern. All right, and the confirmation for this pattern is when the stock or index closes above the upper trend line across the highs with above average volume. So, you know, you have your channel right here. All right, and then you get the breakout from this flag, and you want to see the volume increase. Just like many of the other, the volume is going to decline during the formation and then expand on the breakout. Now, one thing I do want to mention is that, you know, in this script, it does say stock, all right, but these strategies work for trading different types of equities or asset classes. You can use some of these strategies to trade cryptocurrency. You can use them on forex pairs. You can use them to trade, you know, bonds, bond ETFs, different things like that. So, you know, just keep that in mind, right? It doesn't have to necessarily just be stocks. The next one we're going to look at is a pennant. And in this case, this would be a bull pennant because this is a continuation pattern. Okay, so in this case, we have an uptrend and then we form the pattern. All right, and as it being a continuation pattern, we end up seeing the breakout to the upside. Now, if you're in a downtrend and then you form this pennant right here, you would look for a breakout to the downside. So the pattern type, again, is a continuation pattern. It's either bearish or bullish. And the confirmation for this pattern is when there's a close above the upper trend line drawn across the highs for a bullish pennant and a close below the lower trend line for a bearish pennant with above average volume. Now, when it comes to measuring, you're going to take the distance between the previous steep move leading into the pennant and then add that to the breakout level. The volume declines during the formation, expanding on the breakout. Now, it's a common concept, as you guys can see this being repeated over and over in a lot of these patterns. The next one we have here is going to be the head and shoulders pattern. This is a bearish reversal pattern. The confirmation for this pattern is when there is a close below the lower trend line drawn horizontally across the intervening low with above average volume. When it comes to measuring, you're going to take the distance between the first low to the top of the head, then subtract that amount from the neckline on the breakout. The volume increases during the upward formation of the initial shoulder, then diminishing as the price drops exiting the left shoulder. The volume will then balance out during the creation of the head, only to increase again as the price breaks down below the bottom support level. And here we have the inverse head and shoulders. Okay, this is the bullish reversal version of that. The confirmation for this pattern is a close above the upper trend line with above average volume. You're going to take the distance between the first high and the low of the head and then add it to the upper resistance level on the breakout. The volume tends to increase, leading to the downward movement of the first shoulder, then drops as the price rises. Volume is then balanced during the formation of the head and increases as the price breaks above the resistance level on the second shoulder. Here we have the triple bottom pattern. This is a bullish reversal pattern, and the confirmation for this pattern is a close above the upper trend line with above average volume. To measure this, you're going to take the distance between the first high and the low of the head and then add it to the upper resistance level on the breakout. The volume tends to be low heading into the formation and increase on the breakout. Over here, we have triple top, very similar. This is the bearish reversal of the previous pattern. And the confirmation for this pattern is when there's a close below the trend line drawn horizontally across the intervening low with above average volume. You're going to take the distance between the low to the top of the two highs, then subtract that amount from the breakout level. The volume increases during the formation and then increases below the bottom support level. Over here, we have the bump and run, right? And this is a pretty fun pattern. It's non-directional, bearish. The confirmation for this pattern is a close below the lower trend line drawn across the lows during the lead-in phase with above average trading volume. The price target is the lowest point of the lead-in phase. Now, when it comes to the volume is usually high at the beginning of the phase and then decreases throughout the pattern. So, here in the beginning of the phase, you're going to see the volume be increasing and then decrease, and volume will increase off of the breakout. So essentially, you're going to have this trend line here that you're looking for, and you're leading into it at about a 30 to 45 degree angle, where about halfway through that it goes to a steep angle, a much steeper angle of about 45 to 60 degrees, right? And then you come back down eventually, and you're going to retest these lows, and if you break through them, you should see volume increase, and it should be a nice move to the downside. Now, that's it for today's video. Again, this was the latest installment in the free trading course series. If you enjoyed this video, definitely check out that series. As I mentioned before, I'm trying to make it from A to Z, really start off with the very first things that you want to begin learning before you try to get into any of the more complex concepts. All right, you really want to take things one step at a time and then learn and really get good at, using those strategies. And then you can learn new strategies and start combining strategies together. Once you start combining multiple strategies together, 2, 3, 4, 5 strategies, and you're getting multiple indicators or multiple signals flashing, you're really going to have a lot more confidence in your trade. Specifically when it comes to knowing why you took the trade, what went wrong with the trade. If the trade does go wrong, let's say you see some pattern forming, but you forget to check on the volume, right? And you see a false breakout on perhaps an inverse head and shoulders or perhaps a cup and handle, and the volume is actually decreasing on that breakout. That could be something that you were missing. Even though the chart pattern was there, you have to remember for confirmation, you're going to want to see volume expand and increase along with that. So that's it. Once again, smash the like button, subscribe to the channel. Thank you guys for watching.